Fraser Logistic Trust, like most of the REIT, experienced drop in dividends for this half's distribution. The increase in their finance cost is one of the main reasons they have highlighted in the past few quarter analysis. Later in the video, we will analyze through how you can foresee the rise in their finance costs. OUE Reit also announced their results, and I'll go through why their dividends might drop in the upcoming quarters as well. For those who are new to Fraser Logistic and Commercial Trust, they are a REIT which has very good properties because of the logistic and industrial sector. The management has been actively trying to expand into properties of logistic and industrial, as the performance are much better compared to commercial properties. They have 90% overseas properties, so foreign currencies plays a big part in Fraser Logistic and Commercial Trust's overall income. Previously, I have constantly sung off my concerns on Fraser L&C's debt maturity profile. With the cheap debts required to be renewed, their cost of borrowings will increase, which will mean that more income needs to be put into paying their debts. This is a main problem for most REITs, and even as federal rates cut interest rate, if they do not cut fast enough, REITs that needs to refinance their debts will still suffer from higher interest rate refinancing. If we look at their latest results, loans for financial year of 2024 has been fully renewed. Even though their leverage ratio is still at the lows of 33%, their cost of debt has increased from 2.8% to 3.1% just quarter over quarter. This was due to the refinancing of the debts, and with financial year 2025 and 2026 having another huge bunch of debts that needs to be refinanced, I expect their borrowing costs to continue to increase. As investors, it's very important that you take precautions on the REIT's debt maturity profile in a high interest rate environment. Even though interest rate is coming down, once debt maturity hits, REITs will still have to refinance their debts at a very high level. For REITs, tenant lease renewals is important in ensuring that the REIT's income can continue to increase over time. For this quarter, logistic and industrial properties are doing well with 19.9% rental reversions for 12 leases. Commercial property rental renewals did not do as well with negative 3.4%. The positive note is that it's only a small lettable area, so the decrease in the income will not impact Fraser L&C heavily. When we look at the lease expiry, logistic and industrial trust leases are the leases we would be hoping that will expire, because it will have the demand for tenants to renew their leases at higher prices. The opposite is true for commercial leases. However, commercial leases will have quite a lot to renew next financial year, while logistic and industrial only have 4.2%. So this is another pointer that you have to take note, because more non-performing asset leases will be renewing this upcoming financial year. After looking at the leases and debts, we can see that the revenue and NPI increased by 8.4% and 3.7% respectively. However, finance cost is the differentiating factor, increasing 45.6% year over year due to the refinancing of their cheap debts. So even though their properties are bringing in more income, the distributable income is 5.1% lower because the growth in the expenses is higher than the growth in the income. Therefore, this resulted in lower DPU of 5.7%. So what can we conclude from Fraser L&C's results? 1. Good rental reversions of leases resulting in the organic increase in the property income. This was largely thanks to the leases renewed in the logistic and industrial sectors that has been doing well. However, in the next upcoming financial year, more commercial leases will be renewing, which are not going to perform as well as logistic and industrial leases. Next, as I warned in my past few videos, the finance cost will increase drastically once the debts needs to be refinanced. This can be finally seen from this quarter's results. When they have to fully refinance the cheap debts in the financial year of 2024, their finance costs increase sharply year over year. Unfortunately, their finance costs might be expected to continue to increase due to the additional large amount of loans that needs to be refinanced for the financial year of 2025 and 2026. One of the easy ways to see is that their current average cost of borrowings is still at 3.1%, while the Fed interest is currently at 4.5%. I would expect their cost of borrowings to continue to increase once these debts are refinanced. At the current share price, the dividend yield is approximately 7.5%. However, if the dividend continues to drop, the dividend yield will be expected to drop. Next, let's go to the next REIT, and that is OUE Reit. OUE Reit is different from Fraser Logistics and Commercial Trust as it contains office, hotels, and shopping malls. They are considered a small REIT with only 7 properties, with 6 properties in Singapore and 1 property which is Lippo Plaza in Shanghai. Looking at their key highlights, revenue and NPI dropped 1.3% and 3.7% year over year respectively. This is not desired as this might hint of lower dividend in the upcoming quarter. Singapore properties are performing well, with Singapore office assets achieving 10% positive rental reversion. Singapore hotel increased 0.3% year over year revenue per room. Lastly, Singapore retail achieved 16% rental reversion. Remember these performances as later you will see the performance of the China property. If we look at their results, interestingly, the management for Q4 this year will opt for 50% fee in cash and 50% in units rather than the usual 100% in cash. This will provide REIT with the cash to give as dividend, or the management can keep the cash for any potential acquisition. However, this can be a bad thing because at a low share price, it will mean that more units will be issued to the management for their fees. This will dilute shareholders and might not be good for the REIT in the long term. Similar to all other REITs, expensive loans is a problem for OUE Reit. Average leverage ratio went up from 38.7% to 39.3%. Moreover, the cost of debt have increased from 4.7% to 4.8%. So what this means is that when they report in Q4, if the revenue and NPI continues to drop and interest payments of debts continues to increase, the distributable income will be expected to drop. On the bright side, they do not have much debts that needs to be refinanced until the financial year 2026. Hopefully by then, interest rate will drop, and when they refinance, it will be lower than their average cost of debt of 4.8%. Next, let's look at their leases breakdown of the individual assets. Singapore offices are performing well with slight increase in passing rents, occupancy, and good positive rental reversions. As this continues, it will help to boost OUE's REIT's income as these leases get renewed in the next 2 financial years. The reason why these slight results was not given in the key highlights was because China property is not performing well. Similar to Mapletree Logistics Trust and Mapletree Pan Asia Commercial Trust, they are experiencing negative rental reversions with office occupancy at a horrible rate level of 74.6%, even though the retail is at a decent level of 97.8%. This will also be one factor that will continue to pull down OUE's REIT's income. Mandarin Gallery, which is the Singapore's prime location shopping mall, experienced good rental reversions of 16%. Even though occupancy dropped slightly, I feel that they can easily replenish back as these prime locations are always in demand. Singapore hotels did not perform as well as the other 2 asset classes. Their hotels performed with mixed results, with Hilton Hotels' revenue per room dropping while Crowne Plaza Hotels increased. However, main thing for the drop in income was due to the normalization of tourist spending on accommodation. Similar to my previous concerns, tourism might normalize from the COVID surge spending, therefore affecting the retail and hotel businesses. Overall, OUE Reit has good Singapore properties but might have lower dividends due to the following reasons. 1. Poor performance from Lippo Plaza, which is the China property. With the China properties environment not doing well, I expect the recovery to be in a very slow pace. One way to see the China property performances recovering is through Mapletree Logistics Trust China properties. Next, with the normalization of tourism spending, this might affect the Singapore hotels' income indirectly. Next is the constant increase in their finance costs due to high interest payments for their debts. With the income dropping and the finance costs increasing, this will definitely lead to lower distribution. At the current share price, its dividend yield is around 7%. but I will not be surprised if they declare lower dividend for the next distribution. I hope this video gives a good overview on the differences in performances for OUE Reit and Fraser Logistic and Commercial Trust. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment on what are your thoughts on the results for Fraser Logistic, Commercial Trust and OUE Reit. You can watch my other video where I analyze on other banks or other REITs results. Thank you, and I'll see you in the next video.